Okay, so the first thing I want to do is kind of highlight some of the areas that I think are important and which I will almost certainly use for the examination. So without further ado, let's get started. So in the next few slides, we're going to go all the way back to the very beginning, the idea of the basic accounting equation, which is assets is equal to liabilities plus equity. And I don't know that I need to, again, talk to you about what assets are. I think that hopefully by now you know what assets are. And you should know also that those are classified as either current, long-term, and sometimes we call those non-current or property, plant, and equipment. And then the intangible assets. All of these go onto the left-hand side of the equation in terms of their normal sides. That means they go up on the left and they go down on the right. So I just want to throw in here, now that we've already gone through the entire 10 chapters, you should know a little bit something about some of these contra assets that we talk about, which are things like allowance for doubtful accounts, which are things like depreciation allowances and those sorts of things. Now, on the other side, of course, we have liabilities and equity. Liabilities can be classified as current, long-term, and sometimes those are called non-current as well. Those are right side entries. In other words, they go up on the right and down on the left. So if I incur a liability, it goes up on the right. If I pay a liability, it goes down on the left. Now, equity, sometimes we just describe that, and this is a simplified version of it, but it's what's left over. So the reason I say it like that is because you can look at the accounting equation differently and say that assets minus liabilities is equal to equity as well. The main takeaway for this particular slide is over at number 3 when we talk about current assets forming the numerator for the current ratio. Current ratio is a liquidity ratio. It determines or helps determine for investors and suppliers and so forth how quickly they can be paid. If you have a liquidity ratio that is well over 1 to 1, so in other words, I would be looking for something that's closer to 2 to 1, then you have a pretty strong ability to pay those loans and so forth back. And as I'm sure you know by now, current liabilities are obligations of a firm that will be paid in a time certain. Anytime we do a liability, we know when that liability is due to be paid. The main takeaway on this one, so hopefully you know that about liabilities now, are a couple of things. The first is to remember that unearned revenue is always a liability until it is earned. And when it is earned, then we will take it out of the liability. We'll debit the liability and credit the actual revenue. Now, the other takeaway is, of course, that current liabilities form the denominator for the current ratio. So I think maybe I even have something in here for that for you to see. I do. In fact, here are a couple of things. There's a balance sheet that is again, a simplified balance sheet. They get much more complicated than this. And if you ever want to see what one that is really complicated looks like, go out to General Motors or Apple or any of the big companies and see what their balance sheet looks like, and you'll see that there are all sorts of things out there that we haven't discussed in this class, nor will we discuss in this class. But when you look at this particular balance sheet, I have bolded the idea of total current assets and bolded the concept there of total current liabilities. And when we divide one by the other, what we get is $650,000 divided by $325,000, or a ratio of 2 to 1. That is a good current ratio. In terms of the acid test ratio, or the quick ratio, what we're going to do with that is start with current assets, remove the inventory and the prepaids, and then divide that by total current liabilities. And in the example I'm shown here, we've taken the $650,000 worth of total current assets, subtracted 200,000 for inventory and 50,000 for prepaids to get the ratio of 1.23 to 1. And that's the way that we always describe these, 1 point something or 2 point something or whatever to 1. And also, as you should be aware of by now, equity actually has 4 components. And there's actually a lot more than that in equity, but for our purposes at this point in your young accounting careers, there are only 4 components of equity. 2 of them make equity go up and 2 makes it go down. The reason I started with the downside is because I want you to get a visual of the left side being the downside for equity. And so the 2 things that make it go down are withdrawals, and later on we're going to call those dividends when we start talking about larger corporations, and expenses. Expenses are drags on the revenue of a corporation or a company, and they therefore make your equity go down. They would represent things like salary expenses and wages expense and taxes expense and so forth and so on. On the other side, we have 2 things that make equity go up. And again, I've put that on the right-hand side here so that you can see that equity goes up on the right and down on the left. The ones that make equity go up are revenues. Those are the things that we're in business to do. So if I'm an accountant and I sell accounting services, that's my revenue stream. If I'm a roofer and I sell roofing services, that's my revenue stream. If I'm a merchandiser and sell merchandise, that's my revenue stream. And companies will have many, many of these revenue streams, typically. Also then, additional owner contributions. And later we're going to call that common stock. But at this point, in these particular early chapters, we call it owner's capital. And those contributions make owner's equity go up. Okay, so if I was trying to think of a summary and things that I would expect you to know, we have 3 account types that go on the left side of the T account: assets, withdrawals or dividends, and expenses. And we have 3 accounts that go on the right side of the T account, at least in the early stages of this: liabilities, owners, contribution, and revenues. Now, you should also know that later on we get into, when we talk about accounts receivable and long-term assets, we talk about accumulated depreciation, which goes on the right-hand side because that's a reduction of the asset. We talk about the allowance for doubtful accounts, which talks about accounts receivable, and that's a drag on the accounts receivable. So that goes up on the right-hand side as well. I think if you think about these long enough, you'll realize that they're very logical. So what are some good examination questions? Well, what's the basic accounting equation? Obviously, that's a primary question. That'll always be on an examination. What accounts go up on the left or debit side? What accounts go up on the right or credit side? How do we compute current and quick ratios, and what do we use them for? What are they representations of? And they are representations of liquidity. Given a list of assets, which are current, long-term, and intangibles. So I may give you a list of asset accounts that may have some accounts payable and liabilities and equity accounts within them. And I ask you which of the items are assets and which are current, long-term, and intangible, those kind of things. So I'm really drilling down into the concept of assets and what they represent, which kind of accounts are in each one of those categories. And could I rewrite the accounting equation as assets minus liabilities equal equity? And certainly I can. And so if you're doing an examination and I give you assets and equity, or I give you assets and liabilities, you should be able to compute the third leg of that. Okay, so now let's go into adjusting entries. And why do we need adjusting entries? Well, because A, we never overstate assets, we never understate expenses, we never overstate income, and if we don't make adjustments along the way, we may have accounts that are sitting out there with different amounts in them than should be in them if we're going to follow those rules. Okay, so the ones that you typically see is an adjustment for supplies, and so we buy supplies and call it 3 different batches, one in January, one in February, and one in March. and we put them in the asset account supplies. And so to say it's $1,000 a month. And so we're sitting there with $3,000, but along the way, people have came and taken supplies and used them up. And so if we're at the end of end of March and we're trying to do an income statement and balance sheet, financial statements, in other words, we need to make sure that we adjust them properly to reflect the fact that we've got $3,000 sitting in supplies that no longer is there. They've used up a portion of that. So we go to the supply cabinet, we count them, and extend them by the amount of money that they cost us, and we come up with $700. So we have to have $700 in the asset account supplies. So the difference between what's in there now, 3,000, and what should be in there, 700, is 2,300, and we have to do an adjustment. In this case, a debit to supplies expense for $2,300 and a credit to supplies, the asset, 2,300. And now, once we do that, the asset supplies is now down to $700 where it belongs. And so when we go to the bank doesn't accuse us later on of committing fraud by overstating our assets. And at the same time, if you think about that same entry, what you've done is you've added to the expense on the left-hand side, which expenses reduce income. So by not understating our expenses, we do not overstate our income. So that's how that kind of all fits together. Now, there's some other entries that you have to be aware of. We buy some things like prepaid insurance. We oftentimes will pay insurance over for a year or even longer. And so we get to an end of the period and we have to adjust for the amount of prepaid insurance, which is an asset. We have to adjust it down. So we would debit the expense for whatever amount we need to adjust and credit the asset, prepaid insurance or prepaid rent or whatever the case may be. Another thing that we have to do is we have to also recognize that we don't want to show our liabilities at a higher level than what they should be. We don't ever understate them, but we also to overstate them either. So if I sold a bunch of tickets for some of the Stallion games, for instance, and so I sold them all in advance, and I got money in advance, so I debited cash and I credited unearned ticket revenue because I haven't played any games yet. Well, if I get to the end of the period and I've played some of those games, it's fair and proper for me to now take that out of unearned revenue, which is a liability. So I would debit the unearned revenue for the amount that's been earned and then credit the revenue stream itself. That gets my revenue stated properly, and that gets my liability stated properly. And there's also a thing at the end of a period where we may have been billed for something and we haven't set it up yet. So let's say that at the end of the period, I got well, let's say in the next period, just to make it simple, I got my utility bill on the 3rd of the month, and I'm now at the end of the previous month, and I have to record my utilities, even though I'm not going to pay them yet. And those are called accruals. We do that for accounts receivable as well. If we've performed a service and we haven't been paid for it yet, we would still need to record it so that we recognize it as a revenue stream. That makes the IRS happy, and it also states our accounting records in a fair way. So for this chapter, I would say some pretty good questions are, how do I adjust supplies for the amount that's used? How do I adjust prepaid insurance or prepaid rent for the amount used up? How do I adjust unearned revenue for the amount that has been earned? How do I adjust salaries for the amount owed but not paid? And how do I adjust accounts receivable and revenue for services performed but not billed? And what I may do is I may ask you for that entire transaction. In other words, I may say, I sold tickets in advance for $10,000 for 100 games. And so I make the entry. And so to make the entry, of course, you would debit cash and credit the unearned ticket revenue. and then I would ask you, then we played 50 of those games or whatever the case may be, and now make the adjustment to unearned revenue to reflect the fact that we've actually paid them and we have earned the revenue, which of course is a debit to the unearned revenue for whatever that amount is, and a credit to ticket revenue, and so forth. So adjusting salaries, usually the way that that's stated is my payroll gets paid on a Friday. The end of the year falls on a Wednesday, or the end of the month falls on a Wednesday. I pay $5,000 a week, and so how do I make the adjustment? And typically, in that particular case, if it fell on a Wednesday, you would debit salaries expense for $3,000 and credit salaries payable or wages payable, whichever one it happens to be, for $3,000. And if you have some revenue that you have earned, that is, you've performed a service but haven't yet billed for it, then you would bill it. And it's simply accounts receivable debit and whatever revenue stream you have as a credit. And so chapter 4 deals with closing entries, and there are 4 of them, but remember what you're going to do all the way through is the first thing you're going to do is you're going to identify whether or not you have an accounting entry. And for it to be an accounting entry, there must have been an economic event that has transpired. You sold something, you bought something, you paid cash, you incurred a debt, you hired somebody that you paid. If you just hired them and haven't yet paid them, no, that's not an economic event yet. Those kind of things. And then you analyze the actual transaction and record it. And so to analyze it in the case of, say, a service that I sold, then I would say, well, I sold it, but I didn't get the cash, so therefore it must be a debit to accounts and a credit to my revenue stream. If I did get the cash, a debit to cash and a credit to the revenue stream. If I paid a bill that I already owed that was set up as an accounts payable, I'll debit the accounts payable and I will credit the cash. When I incurred the bill, then I would have debited something, probably like supplies or whatever I bought, whatever that asset is generally, and then I would credit accounts payable or notes payable or whatever the case might be. And then at the end of the period, after we've done all that, we made our adjustments that we just went through. Now we would come through and do the closing entries. And there are 4 components to closing entries. The first thing is we close the revenue accounts. Now, revenues are normal credits. So in order to close them, we have to debit them. So we debit all the revenue streams that we have, and we would credit income summary. The second thing is we close the expense accounts. Well, expenses reduce revenue, so they are normal debits. They're on the debit side of the accounts. So what we're going to do is debit the income summary for the total and then credit each one of the expense accounts. The key here for both of these is that when you're done, you have something in the income summary account, but you have nothing in the revenue account or accounts, and you have nothing in any of your expense accounts. The income summary takes the place of those. And then we close the income summary directly to equity. And typically at this point in the discussion, we closed it directly to capital, okay? So, but it'll be whatever equity is set up, if it's stockholders' equity, retained earnings, whatever the case may be, you'll close it to that. And then lastly, we have to close out the drawing account, or if we have dividends, we close out the dividends account. And what we'll do with those is those are typical, or those are normal, I should say those are normal debits, meaning that they were recorded on the left-hand side. So we have to get rid of them, we have to record them on the right-hand side. The debit will go to capital. Bottom line is that when we're all said and done, all of these revenue accounts, expense accounts, and the drawing or dividend accounts, those are all closed. The only thing that's remaining here, oh, and the income summary is closed as well. The only thing remaining here is your capital account or your primary equity account. Okay, so I'm not going to go through every item or every single item in this chapter, but it's a fairly comprehensive chapter. You're being introduced to a new kind of firm. We're dealing with service-based firms, and this is a merchandising firm, or this chapter focuses on merchandising firms. It'd be like a Walmart or an Amazon. Those are two good examples of merchandising firms. You have some new terms, merchandise inventory and cost of goods sold. You have merchandise available for sale. You have beginning inventory, ending inventory, and those are just in the just accounting for the inventory side. And again, I would encourage you to kind of think of it in a very simplistic way. So if you open your cabinet and you have 2 cans of soup of a particular type, then you have a beginning inventory of 2. And if it costs you $1 a piece, well, you have a beginning inventory of $2. And now you go out and you buy, let's say, 5 additional cans. So now you have 7 cans that are available for you to consume at $1 a piece or $7. So your merchandise available in this case, or your soup available, which would be the same thing as merchandise available for sale, would be $7. And so now you consume 3 cans, okay, at $1 a piece. That's your cost of goods sold. That's the same concept. What's left is your ending inventory, 4 cans at $1 a piece, or $4. That would be how you would walk through the merchandise inventory side, the cost of goods sold, the goods available for sale, and so forth. But again, take particular care as you go through this chapter, because there are going to be probably 8, maybe even 10 questions that come out of this chapter. Discount terms. Discount terms are cash discount terms. What that means is if I pay for the goods within a certain amount of time, then I get a discount. And if I don't, then I have to pay the entire amount at the end of the period. So typically you would see those stated as a percentage and then a slash and then a number of days that you're allowed within which to take the discount, a comma, and then a net number, and usually it's 30 days. That's typical terms. So in other words, you might see 1% 10, 1% slash 10, comma, net 30, meaning that if I pay the bill within 10 days, I get to take 1% off of it and only pay 99% then therefore. And I have to pay the net in 30 days if I miss the 10-day window. So that's, that's just make sure you go through there and look at that. Sometimes we talk about companies that to put them in terms of the net instead of the gross. In other words, they automatically assume that discounts are going to be taken. So in that case, they would put it in at 99% instead of 100% and then subtracting the 1%. And we also have to look in this chapter with freight considerations. And we have this kind of archaic term called free on board. And what follows that free on board is what's really indicative of whether or not you're going to be paying the freight or the shipper will be, the seller that is, paying the freight. And so if it says FOB shipping point, then that means that the buyer pays the freight. If it says, let's say you have, let's say the suppliers in Atlanta and and our company's in Auburn, and so if it says FOB Atlanta, that means that we are paying the freight. If it says FOB Auburn, that means that the shipper is paying the freight. Or if it says FOB destination, and we have to then figure out which of those it is, and if it's a freight that we have to pay, then that will be added to our merchandise inventory. Okay, now purchase returns and allowances, those are offset to the purchases. So if I have something, and the difference between a return and an allowance is a return, I actually return the goods. So I bought something, I bought 10 of them, one of them was defective, and I sent it back for credit, okay? If an allowance is something different, I got 10 of them, one of them was damaged, and the damage was not significant enough for me to have to send it back, but I expect the company to give me some sort of an allowance, a 10% discount, or a 20% discount or whatever. And I will take that off the cost of the merchandise inventory, and I'll remit the amount less the allowance or less the return. Now, where it gets tricky, and this is the part that I think you should really take a look at, is when I buy something um, at net. In other words, I already take the discount, and then I return that something or some portion of that, and um, and and then I pay it, and I pay the amount within the discount period. And so you have to make sure that that portion of it that was returned comes out, so that you're not taking a discount on the entire amount, but you're only taking the discount on the amount of goods that you actually kept. So again, take a very close look at this chapter. I usually pick quite a few questions from it. Okay, and so as I go through here, what I'm doing is I'm giving you the high points of the chapter, but I'm also giving you those areas that will likely be those used for questions, okay, on your examination. And this chapter, chapter 6, is this one, and it deals with the 4 different inventory methods: specific identification, first in, first out, last in, first out, average cost, as those 4 methods, and they're different in terms of how you handle them. Okay, so specific identification, that's a fairly easy one. It's like what a car dealership uses. You have a VIN, and every VIN is unique. So if I sell a Chevrolet of a certain type, it has a specific VIN, and no 2 Chevrolets of that type and even color and body style, whatever, have the same VIN. They all have a unique VIN. So I can identify exactly which one came in and exactly which one went out the door. Um, and so that's a fairly easy one to recognize. So if I buy a new car in at the dealership for $18,000 of a specific VIN, and I sell it for $22,000, then I have a sale of $22,000 and I have a cost of goods sold of $18,000. So it's fairly simple. With first out, when you start building inventories, that becomes a little bit more difficult. Essentially, what it says is the first ones that came in would be the first ones out. Probably 80% of all companies use first in, first out as a method. Because what we'd like to do is we'd like to sell the ones that we get in first. I mean, that's kind of common sense if you think about it. And especially if you're thinking about things like grocery stores, produce, those kind of things. If you don't sell the first ones that you got in out first, then you'll wind up with a lot of spoilage and waste that you have to account for. Last in, first out is obviously different, exactly what it says. The last ones that you got in will be the first ones that go out. So when you're starting to build up your inventory, the ones that are oldest in inventory will be the ones that are left in inventory. Okay. In the first in, first out method, the last ones that you got into inventory will be the ones that are left in inventory. Average cost, just think about your GPA, because that's exactly the way that you compute it. If I got a class that was a 3-hour class and I got an A on it, and an A is worth 4 points, and I have 4 points. And if I have another class that's only a 2-hour class and I got a B in it, then they're worth 3 points. So I have 2 times 3 or 6. So now I have, in this case, 12 quality points, 4 times 3, and 6 quality points, 3 times 2. And so I have 18 quality points divided by 5, because I have one class was worth 3 hours and another class worth 2. But anyway, just take a look at your GPA, because you're going to calculate average cost exactly that same way. Okay. If you have one that goes out the door, though, then you have to go back and pick it up at the average cost that it went out the door at, and then so forth. And again, you want to look pretty carefully at this chapter, because it's one that you can do a lot of testing over, and typically we do. Okay, so you probably would see about 8 questions come out of here. So These last two chapters, you're looking at 16 of the 50 questions. All right, consignment inventory. Consignment belongs to somebody else, so we do not pick it up in our inventory. In transit inventory, that depends on whether you pick it up or not, depends on whether or not it was FOB shipping point, in which case you would pick it up. If it's still in transit at the end of the year and it was FOB destination, then it's not yours yet. It's not yours until it hits your dock. So therefore, it still belongs to the shipper and is not considered part of your inventory. Again, these are some of the things that I probably will test. Well, I know I will, but concentrate on these probably more heavily than some of the other things and know how to make these calculations because that's what you'll be asked to do. Okay, so I told you that the last two chapters would have someplace between 16, maybe even 18 questions. So somewhere or another, if I've only got 50 questions, something has to give. And this is part of where it will give. If I do ask questions over accounting information systems, it'll be a very small number of questions. It might be something like, what kind of a device is a mouse? And of course, it's an input device. What kind of a device is a printer, which is, of course, an output device, or same thing would be true, of course, for a monitor. I might ask you what goes into a purchase journal. It's a specialty journal, of course, and the only thing that goes into purchase journals are accounts payable and purchases of merchandise. And if I ask you anything about a sales specialty journal, of course, that's an accounts receivable and a sales, because it only records those things that go on credit. If it says something about you paid cash or you received cash, then it would not go in the purchase journal. It would not go in the sales journal because those things go into the cash receipts or the cash disbursements journal. But anyway, probably not more than 2 to 4 questions here. Okay, so I like this chapter as well because it is full of very useful things for you to know. Some of them are very practical, like the bank statements, so you can see as many as maybe 5 questions on bank statements and change funds and so forth. You'll have to know how to handle cash over and short. You'll have to know how to handle deposits in transit. You may have to complete a bank statement. So those are all really important things simply because they're so practical and things that you'll use for the rest of your lives. Why do we have internal control to begin with? Well, we're trying to protect assets. We're trying to ensure that the financial statements are fairly stated, and those sorts of things. And again, you can look those up in your slides, but those are the kind of questions that I might ask. Why do people commit fraud? Well, there are 3 reasons: opportunity, financial pressure, and rationalization. And those are the kind of things that you'll be asked on your examination. So you want to take some time to go over this chapter. I'm guessing I'll probably pick as many as 8 questions from this chapter as well. Okay, you can probably expect to see 4 to 5 questions on accounts receivable. I will ask you to solve problems using the income statement approach and using the balance sheet approach. So remember, what we're really talking about here is under the income statement approach, whatever the expenses that we calculate. So if I say that the expense is 3% of net sales and you have $1 million worth of sales, then the expense is going to be $30,000. And the allowance for doubtful accounts, if it doesn't have anything in it, will be $30,000 as well. If it has a debit balance in it, it'll end up less. If it has a credit balance in it, it will end up more. So we don't really care in the income statement approach what happens to the allowance for doubtful accounts. We're just going to make an entry and let it fluctuate accordingly. Okay. Now, under the balance sheet approach, there's a different focus here. Remember that what's on the balance sheet? Well, assets, liabilities, and equity, and part of the asset group is going to be your contra assets, which in this case is the allowance for doubtful accounts. So if I calculate the allowance for doubtful accounts to be $30,000, that's what it has to be. And I have to structure the entry of bad debt expense and allowance for doubtful accounts accordingly. So if in the same thing, if I had $30,000 that was in the that I calculated as being the necessary balance in the allowance, that's what it has to be. So if I had $10,000 on the debit side of the allowance, then I'm going to need a $40,000 entry to make that happen. If I had $10,000 on the credit side, I only need a $20,000 entry to make it happen. So debit to the bad debt expense and allowance for doubtful accounts credit of $20,000. In the first case, $40,000. So the allowance for doubtful accounts, whatever you calculate, that is the balance. Everything else, the entry has to fluctuate. Under the income statement approach, the entry is whatever you calculate, and the allowance for doubtful accounts fluctuates. And that's the main focus of that. I think that I've got, well, I know I do, have a on the internet under my channel there's some problems that I worked out relative to this. So you want to pay attention to those particular things, because there'll probably be 5, maybe even 6 work them out type things that you'll have to do for this one. Okay, in chapter 10, we're going to be talking about property, plant, and equipment, things like land building, land improvements, and then intangible assets as well. And some of the primary focuses that you need to be aware of is what kind of costs go into building up an asset cost. So essentially, it's all the costs necessary to get it ready for production. Now, those are normal and necessary costs. So I always make the example of, if I have to build a 4-inch platform, 4-inch concrete platform for a piece of equipment, then that's part of the cost of that piece of equipment. If I build that platform and then when I'm unloading the piece of equipment, I drop it and break the platform and have to rebuild it, that's a repair. That's not a normal cost. That's an abnormal cost. The other part that you want to be aware of is, how do you allocate costs among buildings and land? So I buy this piece of property for $100,000, and I have an appraisal done, and the appraisal shows that the land is worth X and the building is worth Y. And so I have to be able to allocate that $100,000 for the cost based upon the appraised allocations. So just to be, let me just give you an easier example that you can put your arms around. So I have a piece of land that's appraised at $60,000. I have a building appraised at $40,000, and I have $90,000 worth of asset costs. So now I have to take 60 over 100 times 90 for the land, and 40 over 100 times 90 for the building, or 54 and 36. Okay. All right. Now, also we have straight line units of production and double declining depreciation. There will be a question, at least one question, over every single one of those types of depreciation. So make sure that you review them and know how to do them. And this is the tricky one, double declining depreciation. That's a tricky one, because in your last year, you're going to calculate a depreciation amount that you cannot use because you can't go over the salvage value. So look very carefully at those. Again, I like those kinds of questions, and you will probably see at least, I'm guessing, 6 to 8 questions there. So just to kind of sum it up, the merchandise inventories and the merchandising accounts, these cash and cash bank statements, allocations of expense and depreciation. I'm not sure yet whether we'll have 50 or 60 questions, but you can count on probably 75 to 80% of the examination coming from chapter 5 through 10, and the other 20% or so coming from chapters probably 3 and 4. Okay, that's where my focus will be, on chapters 3, 4. Um, so, um, so be looking for a large number of questions from this chapter, chapters 5, 6, and whatever the cash chapter is. And then the rest of them be reasonably um, similarly allocated. And that's all I have. Study hard and make sure that you're ready for the exam the day that it opens up. Thanks a lot. Enjoyed the class. Enjoyed having those of you who were on campus, and certainly those of you who started and finished online. I hope to see you again going forward, and I wish you much success in your continued academic careers, and certainly hope that you will stay safe throughout the rest of this crisis, which hopefully will be over very soon. So thanks again. Have a great summer.